Welcome back. The Federal Reserve's pivot away from rate hikes is likely good news for U.S.-listed REITs. Joining us for more on the real estate landscape heading into the new year, Rich Hill, head of real estate strategy and research at Cohen Steers. Rich, so you say that after a challenging 2 years in CRE, 2024 will mark an inflection point in real estate investing. Is that purely just based on the direction of rates?
Sure. Good morning, and nice to see you. Thanks for having me on. Well, look, it's been a really tough 2 years for commercial real estate, and specifically listed REITs. They're down around 17% on a total return basis from their peaks at the end of 2021. Prices are down around 22% or so. But believe it or not, they were down even more at their trough in October. They were down around almost 35% or so. But what we've seen over the past almost 2 months now is a big rebound in listed REITs. They're up more than 25%, believe it or not. Actually, November was the 5th best month ever, and the strength has continued in December with returns up around 9% or so. So you're right that some of this has to do with the decline in interest rates. We've seen a really big pivot where interest rates, both nominal and real rates, have declined. And we do think the market is pricing in a 1% real rate environment or so. But that's not the only reason that listed REITs are doing a lot better. Number one, credit markets feel a lot better. We've seen a significant rally and tightening in credit spreads, both investment grade corporate and real estate debt spreads. But also growth is holding up really well compared to historical averages. Growth is around 5% or so right now, compared to the historical average of around 2.5% to 3%. And certainly recessionary environments are even weaker than that. So it's a confluence of a number of factors. Certainly interest rates are helping that, but credit spreads are also helping that. We think the worst is behind us on the credit side, and growth is holding up pretty well.
Fundamentally, office has gotten a lot of attention this year, of course, especially as you see some pretty shocking headline numbers of certain office properties going for, say, 50% of the value that the buyers paid just a few years ago. And people will point to supply and demand issues here, that there's just an oversupply of office out there and not too many companies that need that amount of space, especially as they kind of pivot to more hybrid or work from home models or just rethink their work spaces in general, looking for newer and bigger and open environments. So kind of how do you reconcile that? I know office is, just a fraction of the overall REIT market, but it is one that's getting outsized attention.
Yeah, and by the way, that outsized attention is warranted. To maybe level set, office is only around 3% of listed REIT exposure. So it's relatively de minimis. As a percentage of the overall commercial real estate market, it's a lot higher, at north of 20% or so. But I want to be clear, those headlines are very real. We've seen listed REIT exposure in the office market down more than 50% from peak to trough. Look, we think the listed REIT market is a leading indicator in both downturns and recoveries. So as we think about the office market, and maybe as a microcosm for the overall commercial real estate market, we think valuations are only 50% of the way through their declines. So what we've seen happen is the private market reset to take advantage of the higher interest rate environment. But the next leg lower that we're going to see happen in 2024 is really more distress working its way through the system. So you're right. You're going to see a lot more headlines like this with valuations being down more than 50%. I think you're probably going to see some headlines that are even more severe than that.